Hi everyone, this is Michael Kramer of Mott Capital. Today is Tuesday, July 9th, and it's around 5:30 New York time. So economic data will really start picking up here in the U.S. Starting on July 11th. That's when we're going to get the big June CPI report. It's actually not expected to be such a big deal, though. Forecasts are for June inflation to only have risen by 0.1% on the headline. That's expected to be a little bit higher than last month's reading of 0.0%. Core is expected to rise by 0.2 in line with May. Headline is expected to rise by 3.1% year over year, down from 3.3, and core is expected to rise by 3.4% year over year, in line with May. Initial jobless claims have been a big statistic of late. The bigger number being continuing claims. This number has been rising consistently now for a couple of weeks. Expectations are for 1.864 million. Again, this is the number I think that probably matters the most at this point, because we are starting to see continuing claims pile up. You can see that basically since April, we've seen continuing claims move up rather sharply, and you can see this is the highest level we've been at, basically going back to 2021. So this is an important statistic because sometimes it can be a good leading indicator to the unemployment rate here in the U.S. Then on Friday, we're going to be getting PPI, looking for 0.1% month over month. That's going to be expected to be up from last month's reading. Year over year, looking for 2.3, also up from last month's reading. We're going to also get preliminary University of Michigan numbers. Expectations for inflation expected to be 3% for both the 1-year and 5 to 10-year outlooks. And then, of course, next week we're going to kick off with retail sales on the 16th. So a lot of stuff going on here in the U.S. over the next couple of days. What we've been generally seeing is this consolidation in the dollar index. We're really just not getting any clear signs of what way this market wants to go, other than the fact that it wants to consolidate right now. It seemed like maybe with the job report we were going to get an opportunity for that to change. That just hasn't happened yet. When we look at the euro also continues to basically meander higher right now and heading towards the upper bound of this downtrend that's been in place. Again, the French election's kind of come and gone now, and we haven't really seen yet a meaningful change in direction. Right now, this area in here is serving as resistance. Really nothing here to suggest it should, but that's what seems to be happening. So I would be watching the 108 and a half area. If we can break above that, then clearly we're talking about a move back up to this area right below 109, which really could pave the way for a significant move higher if you can get through it. Otherwise, I think you're still looking at another test of this lower bound around 107. I mean, I don't know what the data is going to be later this week, but certainly a surprise inflation report that comes in hotter than expected, or a hotter PPI report, could certainly trigger a stronger dollar, weaker euro scenario. But right now, we're just not getting anything to give us any clear indication of where the euro wants to go, other than the fact that we're just ping-ponging back and forth between these two trend lines. When we look at the pound, it looks like we were able to get above the downtrend, but we still haven't gotten beyond this 128 area, which has continued to be resistance now, going all the way back to August of 23. So we've been now 1, 2, 3, 4 times. This is now the 5th time that we've gotten to this 128 region, and you have to think that if you can't get through this area again for a 5th time, that the next area we're going to look for is got to be at this lower trend line at 125. And if we can't get through it, you got to think that this also potentially sets up this double top pattern that also suggests we go back to 125. So momentum has clearly been more on the bearish side of things, with it moving lower, a bearish divergence versus the rising trend in the pound. But again, this area right here, 128 to 129, just very tough for the pound to get through. And until we really see something to trigger it, whether it be maybe weaker inflation data, something that shows that inflation has really rolled over here in the U.S. and the Fed's going to need to cut rates much sooner, rising employment claims, rising initial job, rising continuing claims. Something needs to be a trigger for this to happen. At this point, we're just not getting it. The yen just continues to push higher. There's really been no change in trend here. We just continue to find support at 160 right now, and there's no reason to think that this trend can't continue, at least for a little bit longer. 164 seems like the next viable spot. When we swing over to oil, oil got up to this $84 area and has backed off. We're going to watch support here at 82. A break below this 81.5 to 82 area clearly sets up a return to much lower levels. I guess we need to start asking ourselves, is there some sort of downtrend actually in oil that is really present here that starts off of this top, or potentially there's some sort of downtrend in oil that starts at this level, because you can clearly see that oil, what's clear at this point is that oil is making lower highs, but it's also clear that oil is still making, higher lows, and that really also tells us that oil right now appears to be in some form of consolidation. And so again, just like the dollar, we're not really getting any meaningful directions and signals other than the fact that we can play ping pong between the two trend lines that have been developing. When we look at gold, you can see that last week we were talking about some of these resistance areas in gold, and we were talking about this potential to either break out or down, and that the upside potential was to the upper Bollinger Band, and that's pretty much where we've gotten. And now at this point, with gold breaking out to the upside, it certainly, and to retest these highs in here. So we're just going to have to wait and see what that means if it should come, because if gold were to really stall out here, again, it sort of creates this head and shoulders like pattern here, and with this serving as your neckline at 2285. Clearly we would need to break back down through the triangle. This would be a throw over, and so it's certainly a possibility. If the dollar were to start strengthening meaningfully, I would be looking for gold prices to start heading lower, and especially if we were to see inflation data come in significantly weaker, that could also trigger a sell-off in gold. When we look at copper, copper has been trending higher for the most part. What stands out here is that we have this trend line in copper. We broke it. We came back, tested it once. We came back, tested it twice. So far, the two tests of the trend line have failed. And each time we've hit the trend line, we've made a reversion. At this point, I don't really see anything that stands out to me that signals a direction in either way. I think at this point what we're sort of looking at is copper trying to maybe find a floor in this 440 area. Ideally, I would actually like to see copper come back down and test this 440 area and see how it sort of responds to that test. If it bounces, then it tells us that, maybe we're going to be going on to make another high. Maybe that high comes somewhere along this trend line around 483. If we obviously fail, then we're talking about probably heading back towards the $4 level. And again, we've been following copper pretty much because it's been a good gauge for the FTSE. But at least more recently, there seems to be a little bit of a divergence where we've seen both sort of still going together, but it seems almost like they're starting to separate in some ways, because this high in copper was lower than this high, but this high in the FTSE was higher than this high, which shows you that there's just a little bit of a different level of strength in copper versus the strength in the FTSE. And what we're actually looking at here in the FTSE is this potential descending triangle pattern that's forming. You can also see that the RSI has been kind of stuck around this 55 area. If the RSI were to break and head towards being oversold towards 30, that would indicate a break in the UK FTSE and potentially a return to this lower area around 7,800. If we really started to see some copper strength develop, I would probably lean more bullishly on the FTSE with a retest of this 8,400 region up in here. When we look at the DAX, it looked like we got through the French elections and everything was going to be okay in Europe. And initially the DAX started the day higher, on the DAX had started the day higher following the election results, but it hasn't really performed very well. It's actually been trading lower now, gave back all the gains yesterday, has given back another 1.3% today. You can see I have drawn in here what looks like a megaphone pattern. Again, a break of this megaphone pattern leads to lower levels at around 17,820. In the meantime, I mean, I think your upper level is only up to around that 18,750 area. But again, the DAX really isn't showing a lot of strength at this moment in time. And I think that's largely because when you look at the EUROSTOXX 50, we're also sort of just trending here. And it also looks like we broke a level of support. Obviously, a break of 4,900 opens the door to a lower level at 4,750. When we look at the NASDAQ today was basically flat. We had a really good setup last week that just didn't work out. We broke out. The 2B top failed. The engulfing patterns failed. These were pretty bearish signals, and they typically have worked well in the past. Didn't work this time. One thing that is sort of interesting here is that we have this potential for this rising wedge pattern in the NASDAQ that appears to be present. The thing is, when you look at it, obviously you see that we're trading above it. This could be a throwover. So we just have to be aware that right now, even though these patterns failed, there is potentially a throwover phase in the NASDAQ. I mean, the NASDAQ is, for better lack terms, it is overbought. I mean, RSI is at 77. It was up much higher. You can see it's trading, at the upper band of the Bollinger Band. So it really, again, sort of points to what is an overbought market and really should, lead to some period of consolidation or at least a move back down to the lower end of the range on this pattern. I mean, when we look at the S&P, we have this large rising wedge pattern as well. This is a much bigger pattern than the one I just showed you. There's one in the NASDAQ as well, but I thought for the short-term view, it was better to show you that one. Again, you can see we're just at the very upper tips of it. When you look at how overbought the indices are, and when you break down the construction of what's been driving these indices, which has basically been a handful of stocks, and you see that we're trading at the upper band. We have RSIs of 77 on the daily. You have an RSI on the weekly that's at 76, also trading at the upper bound. And then even when you go out to the monthly, you'll see that we have an RSI of over 70, and we're just below the upper bound of the Bollinger Band. So, I mean, these markets are extremely stretched, and you can see, not that it's trying to make a prediction, but you can see how stretched it is by the distance to where the lower Bollinger Band is. On the monthly chart. I mean, the index would need to fall all the way back down to 3,600, which would be a 35% decline in the market at this point to reach that lower band. And it's not saying that that's going to happen, but you can see that during periods of certain times when you stretch too far along the Bollinger Band, at some point you do come back and retest it. And that's been the case a number of times in the past. It happened, it happened here, it happened here, it happened here, it happened here in a lesser degree because we were able to consolidate for some times in those bands to really come together. It certainly happened during this period of time. So one should be mindful that, when these markets get too stretched too quickly to one side, that the risks really do increase for severe corrections. And right now these markets are really overbought, and there's just really no other way to say that. When you look at the Dow weekly also not nearly as overbought. You can see the difference on the monthly chart between the Dow and the and the S&P. I mean, the Dow would need to fall significantly less, 22%, to reach its lower Bollinger Band, while the NASDAQ would need to fall, I'm sure, something fairly ridiculous, 47% to reach its lower Bollinger Band. So that's how far these markets have really kind of run. And when we look at the Dow, right now, though, what we're watching is this 10-day exponential moving average. Because if the Dow should slip below that, I think it really kind of tells you where this market is, because we haven't even been able to get above 39,550 yet. That certainly is possible. It could happen at any moment. But again, it's worth notating that this has been resistance and this has been support at the 10-day exponential moving. And until you break one of these lines, you're not going to know really. But again, given that we're seeing some weakness in Europe, and you're seeing some really overbought conditions in the S&P and the NASDAQ, you have to think that the weakness spills over to the Dow if it should develop, and the Dow goes lower as well. So that's just sort of where things stand at this point. I hope you found this helpful, and we'll talk to you again next week. Bye.